Well, good evening, folks, and welcome to the 2023 February Roundtable, sponsored by the Mid-Michigan chapter of Better Investing and co-sponsored by Manifest Investing. We're so happy to have you with us. This is our annual Golden Knight Awards evening. We'll still be talking stocks in great detail, but we are going to take 8 or 9 minutes to award some much deserved recognition to some of our knights and damsels for their performance in the last year. It's the only real remuneration that any of them get, and some of us don't get very much of that because we're not as good a stock picker as we should be some years. We are going to be talking about a lot of different things. So without further ado, let's go to the next slide, Mark. Oh, I do want to mention that the folks at the top of the slide, the opening slide, are the various folks that have helped us out on this program during its inception and during its continuation. And the names are in the same order at the bottom of the slide as the people are at the top of the slide. So first on the slide is Candace Baker, and last on the slide is Matt Spielman, going from left to right. And I'll let you kind of match them up with things as you go through those. Meanwhile, I'm going to talk about the disclaimer.
Well, Ken, I would like to just I would like to disclaim that is not my high school picture. All right. Just settling a debate that was erupting before you guys all came in the room.
Okay.
Middle school?
There was a question about whether or not this is a 2023 or 2024 roundtable selection.
Well, the selections were made mostly in 2023. Is that what you're talking about?
Yeah.
The Roundtable Awards are from 2023, Herb, with maybe a month into 2024. We celebrate from February to February, okay?
That was just one of the questions that came up.
Mm-hmm.
Great, thank you. Let's go on to our disclaimer. Mark's found a very interesting proverb there, and he went right by it.
Oh,
so
I'll go back to it. It's a great one.
It's a great proverb. As iron sharpens iron, so one person sharpens another. We really enjoy bringing these events to the people in our chapter, in the country, and in our community. And we hope that you enjoy it as much as we enjoy putting it on. We have a large group of people that help us out on a regular basis, and we couldn't thank them more than we already do, except to say that we know that we couldn't do this program on a regular basis without the help of a lot of folks. This is an educational demonstration. The stocks we're going to talk about are for illustrative purposes only. If we own the stock, we'll try to mention that, but don't hold us to that because we're amateurs. We really believe that you're in charge of you, and that you can do your own investing and your own homework and make your own decisions. And we ask that that's what you do. Do your own homework especially. And before you decide to buy, sell, hold, make sure that it's a sufficiently apropos thing to do for the portfolio that you've put together. If you'd like to be reminded about these sessions, my wife, Natalie, at nkavula1@comcast.net, can help you get on our guest list, on the Mid-Michigan chapter guest list. She can help you be on that list, and then once a month we'll send you a reminder that the roundtable is coming up. You can register right from that reminder, and then you'll get a link sent to you that has a single button to push, and when you push that button, it'll take you right to the session as it is presented on the evening that it happens. If you want copies of the slides from tonight, send an email to Mark R. at manifestinvesting.com. That's Mark's real email address, followed by my real email address. And we'd both love to answer questions that we might raise during these sessions. So drop us a line if you have a question, and if you'd like those slides, Mark R. at Manifest Investing. We do post this session along with all of the roundtable sessions on the Manifest Investing Roundtable YouTube site. We would encourage you to go to that site if you'd like to review one of the roundtables, and we would love it if you would subscribe to that site. We're aiming to get a few more tools that we can use, and to do that we need a few more subscribers to our website. We made it past the 1,000 mark, and now we're moving towards the next step along the way before we can get some more of those tools. Next slide, please, talks about the roundtable performance. You can see over on the left what we said in the beginning. And the beginning was about 14 years ago. In fact, 14 years ago to the month of February, when we sat down and we said that we would have some nights. At that point, it was Mark Robertson, myself, Cy Lynch, and Hugh McManus. And we said we would gather once a month, generally near the end of the month, a lot of times on the last Tuesday of the month, and we would each identify a stock, and then we would follow that. Our goal was to beat the market by 5 points. And the language that we used was to have a relative return, the relative to a benchmark. And the benchmark that we were using and still are using is the Wilshire 5000. You can see in the 14 years we've been doing this, the Wilshire 5000 up at the top of the graph has been returning 11.8% annually. And the tracking portfolio of the stocks that we've chosen has been returning 17.5%. Now, we have frozen some of our positions. We no longer have them active. When a position is something that we feel doesn't have much par left in it, much potential left in it, we have the option of freezing it, and we can also freeze a position for a company that has fallen apart. Obviously, some of our companies have been bought up by others, and some of our companies have gone private, and one or two of our companies have gone bust. So we're keeping that portfolio up to date. Our relative return is our return, that's 17.5, minus the 11.8, which means we're beating the market by 5.7%. That's not easy. We have statistics that show that over long periods of time, more than 90% of all mutual funds and ETFs fail to even beat their benchmark by a little bit, let alone by 5+ points. So we're quite proud of what's going on. None of us are professional analysts in any way, shape, or form, but we do really take what we're doing seriously, and we try to give you good stock selections which have some potential. And we ask again that you do your own homework, take the time to study the stock, and to make your own decisions about whether any of the things we say are things that you believe and are things that will help your portfolio get better. That's the reason we sell, to make the portfolio better, and we ask you to do exactly the same thing. We're trying to outperform with half or more. In fact, our goal is 55% of our choices. We'd like to have a relative return of at least a 0.1% to beat the market by 0.1% or better. Right now, our outperformance accuracy is 48.3%. We need to work on that just a touch. But we'd like to get that up to around 55. Rex Tillinghast, who we've been doing some studying at the bull sessions that are run every Tuesday afternoon, Rex Tillinghast tells us that 55% is a reachable goal. It's an appropriate goal for outperformance. Let's look at the next slide if we could, Mark. Here's the top, 18 or 20 holdings in the portfolio. And you can see that there's a legend up near the top. It's really quite simple to read. As I go across, I can see a 15 times, 15x, with a single ticker after it. That's the ticker for Cognizant Technology, and Cognizant has been chosen 15 times. So when I look down this chart and see $28,000, I know that that originally was $15,000 in different months being put into the portfolio. The best performer is Microsoft, and if you go through the legend, you'll notice that Microsoft's only been chosen 5 times. And those 5 times, that $5,000 has grown to $102,000 plus. Here's a very interesting fact, folks. You can take every single loss in this entire portfolio, every single losing position, and there are some losing positions. You can take those positions, add them all together, and Microsoft will more than cover the losses in this entire portfolio. We've talked at length about our community focusing on the positives in their portfolio rather than focusing on those stocks where they've done boneheaded things or made terrible, terrible mistakes. Focus on the winners. Focus on what you're doing right, because so often what you're doing right is so much better than what you're doing wrong that that right outweighs the wrong 10 to 1 or 20 to 1 or even 100 to 1. Microsoft, $5,000 at now 102,000 plus in this portfolio. This whole portfolio can be found with that citation, that URL there up in the upper right hand corner, starting with www. This is a free URL. You just type it into your computer and it will take you to the entire Roundtable tracking dashboard, and you'll see every single call that we've made and how much of the portfolio each of those calls represents. I think that covers it. Mark, anything to add to that?
Yeah, I would just point out that we do target staying somewhere in the 14%, plus or minus 13 to 14% when it comes to the overall sales growth of the portfolios. So that's good. The overall quality is excellent at 80. That's all top quintile, top 20% of all companies. And here's an area where we need to do some work, and we will return to that next month. The projected annual return is down at about 12%, that 11.8 that you see there. The stock market average return forecast right now is approximately 10%. We would really like to see that number closer to 15 than to 12. So we will probably be talking about some portfolio surgery, corrective surgery next month.
And it's not going to be rocket science, folks. We're going to be looking at companies, and you can see even in this top 20, we have a number of companies we might want to take a look at. It doesn't mean an automatic sell, but when that par moves lower than you can get with a fixed income money market certificate or a fixed income CD, when that par on a stock moves below that point, it might be flashing you a really, really strong sell signal. So we're going to be looking at some of these, maybe with pars under 5% or pars under 4.5% or something like that. I would imagine there's 8 or 10 of them in the portfolio and might represent as much as 15% of the total in the portfolio.
I do think, Ken, we probably would need a GoFundMe to start a GoFundMe for Cy to go on some type of vacation if we're going to talk about selling companies like EPAM.
Well, I don't.
Maybe a cruise to Antarctica.
Are you going to get the shakes on us, Cy? I don't know.
That would be a tough one, yes.
He'll be okay. He's got a lot of information technology to fall back on. All right. Anything else on the portfolio?
Well, no, we need a drum roll and the band needs to start playing, and we're going to
no, that's when
get through this
we're done
in just a few minutes here. But here's our slate of awards. There's 2, 4, 6, 7 of them this evening, and we're going to describe what they represent. We're going to tell you who won and give you a little bit of statistics, but we're not going to dwell on this a great deal because we know so many of you come to this session to hear our stock picks. And folks, we have some really good stock picks with you for this evening. For the folks that are asking how many folks we have in the audience, we've moved upwards. We've moved above that 150 mark that I explained to everybody was our minimum attendance, and we're on our way to moving above 200 now. So we do get a nice audience bump as we move into the 8:45 to 10 to 9 time period. So let's keep moving here, Mark.
Okay. I was also going to point out to Jeannie that we have 200, 250 people watch the session on YouTube. And I don't think it's completely repeat. But here are the 7 awards. We're basically going to...
That number is extremely consistent. 250 to 300 is extremely consistent on YouTube. And they start watching almost immediately when it gets posted.
Yep. So we're going to talk about the best company selections all time and for the year 2023 and who was most accurate. We have a special category called Best Picture and again some best total return characteristics, best performance for the year 2023 and all time. We'll start with this one. I think this is my favorite category. The best selection for 2023. Now we look back about 18 months. So that means that the average company out there has been, in this group of companies for 9 months. Some of them a little bit longer than a year, some a bit shorter. But going back over the years, this has been such a fun thing. I mean, I think back to Walgreen. There's a couple Apple entries early on. I can remember the night that Herb picked Tyson Foods, the night that Hugh decided to own Bank of America. And you could just see the selections over the years. And of course, one of our all-time favorite sessions, I still scratch my head over it, size selection of Five Below when all of the stores were closed. And pretty pristine example of a temporary situation, not terminal. All right, so the winner for best performing stock selection over the last 18 months is Ken in Fabrinet.
Yay!
by a pretty good margin. I tried to jinx you as best I could, but
I know he's been talking about it for 3 months, and that usually is the kiss of death. So we waited it out this year. I'm very pleased. That's my acceptance speech, Mark.
Okay, so what you see there is just some of the best performing stocks of the year. I do want to point out that every once in a while magic happens. Notice that these were all selected at the same time. Many of them are related to the semiconductor industry. Yes, that's foreshadowing, but some pretty good selections, all basically made at the same time. We'll move on to best selection all time. This one has been an interesting category over the years, and we have had quite an Ardelyx moment here over the last few years, and we're not going to escape that quite yet, because in the all-time picture, this Ardelyx, and Hugh, feel free to bow. Hugh first brought the Ardelyx opportunity to us, I would say 6 or 7 years ago. Do you remember how? I mean, you were on the list with the selection made back in 2019, Hugh.
Yeah.
How long ago has it been? Kind of putting you on.
Yeah, it is 6 or 7 years.
So about 7 years.
Yeah.
And it hasn't been the smoothest path that you put us on.
No. Been a little money pump.
But you could see, I mean, those 3 positions are going to be kind of tough to take down. But Ken's Fabrinet is right there, knocking at the door, and all of those selections made on that day are all right here. Keep in mind, these are the all-time standings that you're looking at here, and those are all ranked in the top dozen or so of selections all time. So, wow. All right. One of
Mark,
the
would
things,
would you have said, Mark, that the purchase of Ardelyx in 2022 might have been buying a penny stock? Would you admit to that at least? What do you think?
I'm having trouble here. It's a bad
Yeah, I'm
connection,
breaking
Ken.
up.
You're
Okay, bad
breaking up.
connection. Okay.
As a matter of fact, that 400% relative return comes with a cost basis of 57 cents. It's gone from 57 cents to almost $10. And that's kind of a fun thing to do with real money. So I'll say thanks again, Hugh. Um, yeah, call it a penny stock if you want, Ken, but it's fun. Hey, you owned it from $2 to $6.
I know. I took
So
my money and put it somewhere
I
else.
don't want to
So
hear any more about it. You're eating into my time here. All right. We do like to pick stocks which outperform the market. We measure versus the Wilshire 5000. So we keep track of these also on an annual basis. Ann Manning took home the trophy last year with a perfect score. And you can see that Hugh has dominated this category over the years. And this year, that's actually one of the lowest accuracy ratings that won this category in quite some time. But those were my selections, and about 2/3 of them coming home to roost. So I got the award for best accuracy 2023. All right, all time, again, consistency and long-term performance matters. You can see that a variety of individuals have been at the top of this list from time to time. And as of today, again, going back 14 years, the best accuracy in terms of frequency of market beating selections is Hugh, checking in at that's a relatively amazing 76%. And you can see the selections he's made over the years. Some very conventional core vetted selections, along with some that are a little bit more creative. So congratulations, Hugh. Keep up the good work.
Well, thank you. I've just undercut Ken's speech.
All right, we'll keep pressing on. Here's one of our favorite categories. This is kind of for any feature during the year that gets the attention of the audience. I gauge the number of views along with correspondence in doing this award. As you look down that list, you can actually find all of these presentations, in the Manifest forum. And I'm half tempted to put together a set of links that you can get to these all very easily, because everything from more Spock, less Kirk back in 2011 to our sessions on projected return on value and a whole variety of subjects. We've just had a lot of fun. That's what that image is down on the lower right. Doing this for more than 10 years and achieving the levels that we've experienced is really a whole lot of fun. Any comments there, sir?
Well, who won, Mark?
Well, the three nominees are on the upper right. We've got Kevin Gologly with his Getting Chippy, and I'll do a little foreshadowing. Notice the date. It's that date. Ty Hughes gave a wonderful presentation on optimizing and better utilization of thrift savings plans for a bull session in October, and that will be one of the most popular sessions that we will ever do. A lot of people checking in on it. And then, in deference to Ken's crush on Maria Bartiromo, and actually I found out that Darla was also a crush, so Ken is a man of many crushes. But that's just basically in reference to the strong performance of the smaller companies in the last quarter of last year. And we kind of kicked that off in July. And with a drum roll, the winner is Kevin. We got a lot of people reached out to us and talked about how he walked through the triple play and a variety of things in talking about his selection that month, including a really nice summary on the semiconductor industry. So many people were impacted by that. I hope that, as you can see on the chart back here, a number of people actually were following these semiconductor related companies, and perhaps you even came to own them. So thank you, Kevin. A golden statue in Kevin's direction. All right, last two awards, best performance in a leading role, all of the selections made by the individuals, and what was the average relative return or rate of return for them. You can see that this category has been dominated by Hugh, and with a few interlopers sneaking in there to win it from time to time. And speaking of interlopers, this year it's me again. My third statue this year, so I will have to dust off some space on the mantle, Ken. We did have pretty strong finishes from Kevin Gologly and Matt Spielman this year, but you can see my selections there, and I'll take that type of performance. So, some on in our group, and I love you all, but you have accused me in the past of not carrying the load. I would argue that maybe I have carried the load here, at least my share of it for the last couple of years. Good stuff. All right, and our last award, and this basically is who has done the best job picking stocks since 2010. Whether you're a knight, a damsel, could be the audience. And you can see that this award has shuffled around a little bit. I told you last year it's the one that I probably treasure the most, and I was looking forward to celebrating another one this year. And then this happened. That would be Mr. Herb Lemkool, along with his wonderful spouse, Barb. We did lose Barb last year, but the two of them are two of the best grandmasters you could possibly ever imagine for the Cherry Capital up in Traverse City. So Herb, way to sneak in there and generate the best lifetime return up to this point. So congratulations, Herb.
Thank you. NVIDIA has helped me a lot.
Now, Herb, I have a question. We just brought Cheryl, your daughter, into the Wolves Investment Club. That's my club, and I want to know, does she have the stock picking gene that we can depend on? Because we need a little bit of help right now. So, can we count on her? What do you think?
We'll see how much homework she can get done.
I'll bet she's a good student.
Okay. She'll be an excellent student.
Yep.
I know she's really looking forward to it.
So congratulations, Herb, and keep cranking, and we'll have to have you back a few more times this year for sure.
Thank you.
All right, so there's your summary of the awards for this year. Congratulations to the winners, and everybody keep on chugging. The collective performance is really what matters, and that's doing pretty well. I'm not going to say any more. Ken thinks we jinx it. We talk too much. So with that, let's go ahead and move into our stock presentations. Ken, I'd like to note that I did get that done before 9 o'clock. So there. Let's go ahead and head into our stock presentations, Gentex, and I'm going to actually second this motion made by Houston's own Ann Manning. Good evening, Ann.
Good evening, everyone. I know y'all are going to be feeling like we're hitting you over the head to look at Gentex, but we really think you should look at it because it's at a really good price right now. It was BI stock to study in January and February, and Mark has selected it for the Solomon stock for March, and he's done a real good job of an in-depth technical analysis. So I'm hoping that I'm going to show you some things tonight that maybe you don't know about Gentex.
Okay.
Next slide. This is just some basic information about the company. It's been around since '74. The original CEO retired in 2018, and he promoted Steve Downing to CEO. And I was real pleased that they did this because he has been around since 2002 in a variety of positions in the company. And I like that they promoted within the company. They are located in Zeeland, Michigan, and they have 5,000 employees. And they have two manufacturing facilities there in Michigan, one in Shanghai and one in Germany. And they are considered among the top 100 trustworthy companies in America, according in 2017 and 18. Next slide. Gentex is in the discretionary sector in the auto parts industry, but they themselves think of themselves as an innovative technology company. As you can see from this list, this is the things that they feel like that they are good at. Next slide. These are the three main areas that encompasses their products. Most people just think of them as automotive, but they are also fire protection and aerospace. And as we go along, you'll discover other areas that they are trying to branch out into. Next slide. We know them for automotive, but their very first product was a smoke detector. And this was actually developed to be used in mobile homes because there is such a concern about smoldering fires in a mobile home. And so that was what they developed it for. Then they, in the early 1990s, they developed the first smoke detector with a strobe light for people who are deaf or hard of hearing. They have now gone into developing a smoke detection in cars, which is, I think, is kind of funny considering some of these battery powered cars are catching on fire. But I'm really not sure exactly how this works. But actually, at this point, their smoke detection has gone mostly commercial, and they are in hospitals, hotels, and offices. Next slide. They also are in aerospace. They have developed a what they call a smart window, and it actually adjusts the light that comes in through the window, and they have 5 levels of adjustment that the pilots can do, and these windows are bigger than the standard aircraft window. They've also developed dimmable windows that as the plane is turning towards the sun, it will automatically dim. They initially produced helmet-mounted mirrors for military pilots, and this is actually how they got into going to the rearview mirrors. The technology that they developed for these helmets helped them with the rearview mirrors. The fire protection and the aerospace products, along with a few other small products, only constitute 2.3% of their sales. But when you think about they have $2.3 billion in sales, that really is still a significant amount of money. Once they got into the rearview mirrors, that kind of changed it for all of us. I guess they've been around so long that we've forgotten what it's like not to have these rearview mirrors. I can remember you used to have the little lever that you had to switch so somebody didn't blind you when they were coming up on you from the back. But they have continued to develop their mirrors. They've introduced exterior mirrors. Used to, the mirrors were very flat, and now they're curved, so it helps you with blind spots. And they've also developed things that can be put on the mirror, such as compasses, temperature displays, and garage doors openers. In 2003, they introduced their smart beam system, and this uses forward-looking cameras to detect headlights and tailgates of other vehicles, and it automatically dims your lights so that it's not blinding the person coming towards you. And then in 2016, they developed this full display mirror, which has a video display of what is behind the vehicle. The automotive business accounts for 97.7% of their total sales, and of that, 90.8% is for the mirrors. And they're pretty much are in every car manufacturer in the world. They're in over 500 different car models globally.
Wow.
Next
Didn't
slide.
even know there was 500 different models. Go
I
ahead.
know. Well, you think about each manufacturer, how many different cars that they have.
Yep.
You know, so I guess it kind of adds up. If you look down this list, this is more things that they have developed. And I would guess that each one of you have at least a couple of these on your cars now. And I never realized that they, like I had OnStar on my car. I had no idea that Gentex developed that. But this is a lot of different things that they have developed. This company seems to me to be, they see a problem and they try to figure out, you know, a way to fix it. And as you'll see, as we go forward, that's even more so. This HomeLink system has become a big part of their sales in a short amount of time. You can open your garage door opener, your security gate, your door locks, your security system. And in 2022, this was 6.9% of their sales, which was $132.5 million, and it is growing. Next slide. As I mentioned in the beginning, they consider themselves the technology companies, and these are some of their recent developments that have really nothing to do with the automobile industry. The first one is a nanofiber sensing, and it can detect a wide variety of chemicals from explosive to volatile organic compounds. The second one is they have better lighting for surgeries, so surgeons can dim it or make it bright if they want to. They're working on technology with a company for early detection of Alzheimer's. And they also develop eSight, which helps legally blind and those with low vision regain sight via mobile electronics eyewear. So you can see there are quite a variety of things that they're working on. Next slide.
And we're getting a question / comment about that operating room stuff, and he's wondering if that includes the work they're doing on making this light so that it will help with the antiseptic qualities in the operating room itself. Do you know anything about that?
I did not see anything about that, no.
Okay.
I can't answer that.
Thanks, Sam.
Okay. Next slide. This is a breakdown of their sales, and remember, most of the sales are the mirrors. And I tried to find out what the other international markets were, but I couldn't. But I figure if they're in 500 models, they're pretty much all over the world. Next slide. This shows you how they have grown, and I put into 2 eras in the places that the only times that they've gone down. For obvious reasons, 2008 to 2009, and then 2020. And then since also 2020, they have gone through the strike with the automobile manufacturers. So even though that they've had these down years, you can see they rebound pretty quickly. Next slide. This just shows you their return to their shareholders. I'm not real sure. I couldn't find out why in 2018 they bought back so many shares, but you know, obviously since then they've gone back down to more reasonable numbers. Next slide. This is the only thing I could find on the sales for last year. They have not come up with a presentation. But if you look through this, you can pretty much see everything has increased over either the quarter or the previous year before. And if you would like to see this yourself, this is on their website in the Form 8K that was posted on January 26th of 24. Next slide. These are recent acquisitions that Gentex has made, and as you can see, they really have mostly to do with the automobile industry. Those of you who live in cold weather, I think you would find the second one interesting because they're trying to come up with the technology that can detect black ice. I don't have that problem here in Houston, but I know probably a lot of you do. Next slide. This is a Excel sheet that I put together last year after the virtual Bink class that was presented by Baku Lala. I found this to be very interesting. I've always seen all of these ratios, but I've never had someone say, okay, this is the parameters that would make this company good. So I came up, I made this Excel sheet so it would be easy for me to do it when I wanted to look up a company. And if you'll see in the green below each number, that's where you find this particular financial ratio for each company. And it's kind of like the SSG, where if you look at the graph or you look at management, and if you don't like that, you don't go any further. This is if you have the first three and they are good, then you go down to starting from 4 down. The only two things that were on Gentex that were not in the correct parameters was the gross margin, and that one is actually pretty consistent of what their gross margin usually is in the mid-30s. So the only one that's really off is number 5, which I'm okay with that. And I will tell you that using this is really good if you're doing an industry study, because you can put this companies side by side and see how that they compare to each other. Next slide. This is my favorite thing in the world, me and Kim Butcher. I love a triple play, and Gentex is definitely a triple play here. We have double-digit gains, we have PE expansion, and we have steady or rising net profit margins. Next slide. Okay, I'm missing a slide. Did you go? Can you go back one? Okay, because there's one missing.
Oh, sorry.
No, that's okay.
It's not this one, right?
Yeah, that's this one. Okay.
Okay.
I like to look at other things to see what other people are projecting. As you can see, Value Line's projecting sales at 11%. The corporate guidance is 10 to 12. And I like to look at my fellow BI members and to see what they're projecting, and they're projecting 10. I've been trying to incorporate the prove equation, which you've heard Mark and Ken talk about this. If you do the prove for Gentex, they're coming out at 13.66 for a par. And this is also an Excel sheet that I came up with for myself, that I just have to plug in some few numbers, and when I'm done, it does all the calculation for me.
Mm-hmm.
So anyway, you want to go back to that slide?
Okay, now I'm backing up.
Okay. Okay, and we all know the manifest an equity analysis. As you can see, they're projecting 13.0 sales forecast, and their projected annual return is 17%.
Okay.
Okay.
This actually gets reduced in the current update, so just a tiny bit. Okay, go ahead.
Okay. All right. This is my SSG. As you can see from the last quarter, they had 19.3% increase in sales and 35.1% in EPS. I put in the value line that they go out 4 years, which they're projecting 3,100 for sales and 3.10 for EPS. So after looking at everyone's things, I came up with my projection at 11%, both for sales and EPS. The management, I believe, is doing a good job. They have no debt, which is amazing considering all these acquisitions that they have made recently. Next slide. I like that Better Investing has given us the choice to go back 10 years on all the information. And I decided that I was comfortable taking the 5-year average for my high PE. And today's closing price was $37.10. When I started looking at this back in first part of January, it was at $30.76. So it has gone up a pretty good bit since then. Okay, next slide. As you can see, I have a high price of 68.2. The 29.4 low forecast is 80% of today's closing price. And this gives me the buy zone of 4.3 to 1. Next slide. We have return ranges from mine, which is 10.2. And those of you who know me, I've tried to be pretty conservative in my projections, all the way up to 17 for manifest. So I am quite comfortable telling you that I think this is a good buy, even though it has gone up a good bit since the first part of January. So this is my suggestion for tonight's roundtable.
Thanks, Ann. Yeah, I'm going to go ahead and second it. And here's the bottom line. This is a company that is just screaming when it comes to high quality. We also noticed that the return forecast is near multi-year highs. So it's as high as it's been in 10 years, even though it was a little more attractive, as Ann suggested just a few minutes ago. Notice that the sales forecast is coming down to 11 with the most current value line update. Profitability is in the 20% range, and the PE is in the mid-teens. That does generate a return somewhere in that 14% range, closer to some of the numbers that Ann was kicking around. So you can see that this is a growth cyclical company, and it still manages to be up straight and parallel. It is one of the best companies in terms of all of these three characteristics, and as indicated by the core score. Again, I'm not going to go through all this stuff other than to say they've been through a period in time, and the question to be answered is, where are these operating margins going? That's one of the things you heard Ann ask about. I think they are stabilizing. I think they are innovative. If you want to go through and read a step-by-step description of all the points on here, for example, Morningstar says that they're slightly on sale. The analyst consensus thinks they're a little more on sale. Value line is okay. So if you want to read up on all this stuff, if you go to this link, this is a public free link, which actually will take you through and describe every one of these pieces and the calculation. Here's another version of what Ann was showing you about the projected return on value versus the par. We like to see these reconcile versus each other fairly well, and in this case they actually do. Keep in mind that everything on the left-hand side of this is a traditional income statement based or business model analysis featuring the earnings per share and the PE ratio. The difference here is that we take off at this point, go up here and talk about the things that are part of this projected return on value calculation, and basically just follow it down the page. A PE never gets involved, but you are basically talking about the projected operating margin 5 years out, this number for income 5 years out, compared to the enterprise value, which is represented right here. And again, we like to see these two line up pretty closely, and they do. So I would characterize the buying opportunity as good, not as great as it was, but probably good enough. And since Ann Manning consistently gets accuracy ratings of close to 100%, I feel like I'm in good company.
And I do own this company.
Ann and
so
Mark, we're getting the same question from a couple different people. Ann just said she owned it. Mark, do you own it as well?
I do, in a number of different places.
Okay, thank you.
In a number of our portfolios. But here's my real reason, and this is my 2-slide presentation. Anybody remember those devices on the left? Back in the 1960s, and you see the companies listed there. In fact, Zenith was the last remaining one, and that switched ownership back in 1987. And there's probably some names on that list that kindle some old memories going on here. But here's the reason. When I was a member of the Mutual Club of Detroit, we often talked about this position in Corning Glassware, ticker GLW. And as I sat and listened to the stories, this was a company that they bought because, again, back in the 1950s, 1960s, early 1970s, televisions were the rage. And there were a number of American companies. There are none anymore. But back at that time frame, that was like the internet bubble, or one of the manias that we talk about. The American television was a pretty big deal, and the members of the Mutual Club of Detroit basically said, why should we invest in or try to pick a winner here? How about if we just find the company that sells them all stuff? And that's what they did. You can see the returns that were generated over 25 years with Corning Glassware. Again, relatively boring company. I see a lot of parallel between what Gentex does. They sell to all the automotive manufacturers. They don't care whether it's a battery-driven vehicle or a gasoline engine-driven vehicle. So I see some parallels. I think that the power of that type of a situation can be formidable. So I'm going to go ahead and recommend that we add another position to Gentex.
There was a question in here that talked about the showroom, that they don't give tours, but apparently they have a large showroom for demo for tours that's open.
Okay.
And so the comment was excellent presentation. It's going to recommend our investment club add Gentex to
Okay.
their club. So thank you. Nice job.
Good stuff. All right. Thanks, guys. All right. We will move on to Ken wants to delve into the medical side of things tonight.
I've been fascinated, Mark, with medical devices for the last 6 or 8 months. I've made a number of presentations on small companies that I've discovered doing what I think are almost magical kinds of things with medical devices. And this is a company that I discovered, maybe 5 or 6 weeks ago. I've stumbled across it a number of different times since it came across my radar. Most recently on the Manifest Investing website as the best healthcare stock in the healthcare industry, healthcare sector. I also found it on the Forbes list of the most successful small companies in spot number 11. The company is Iradimed. IRMD is the ticker, and let's go on to the first slide. They're dealing with MRI patient care, and caring for a patient that has to go between sitting in a hospital room attached to all kinds of monitors and having to go into a different place in the hospital to have an MRI, perhaps sit for a significant amount of time inside the MRI machine, can present a whole host of problems to the medical profession. Iradimed makes portable MRI infusion pumps, portable MRI patient monitors, and MRI room entry safety materials. The key is portable in all these different things. They don't have any set of plugs or tubes or anything like that that have to go 100 feet or 200 feet or however long they have to be to get to the machine. They're completely portable. And the key, if you can go to the next slide, is that they have created these tools out of ferrous components. Out of non-ferrous components. The risks are really kind of great when you take patients into an MRI situation. The FDA over the last 15 or 20 years, this is a 10-year review here off to the side, the FDA has kind of kept track of percentage-wise of all the different adverse events that have happened in the MRI situation. And the biggest one has been caused by ferrous, that's metallic, iron components, which create a lot of hazards when you get near this magnetic resonance imaging device. You can alter the fields. You can be risked by getting burned from the conductive wires themselves. And the actual monitors that are being used can actually interfere with the diagnosis coming from the MRI itself. They call it radio frequency noise, and you can actually ruin the entire situation, the entire process by these monitors. So we go to a company, next slide, that has developed using piezo ceramic, completely non-metal unit, and they've made it completely portable. And then they've got 19 different patents with 3 more pending. They've made the unit completely wireless, and they've reduced the noise so that you don't have any of the accompanying noise that you have from so many of the monitors. There's virtually no competitor for this unit at the present time, and I'll speak to that directly in a few slides. Next slide. It's called a non-magnetic IV infusion pump system. Again, it's wireless. It uses a remote. And we're moving towards this new product in the next 9 to 15 months. Somewhere in the 3rd or 4th quarter of 2024, or maybe early in 2025, we're going to have this completely new monitor ready to go onto the market. There's going to be significant replacement opportunity for this new pump as the older pumps are reaching EOL. That's a nice polite way of saying that they're going to become redundant. They're going to run out of a lifespan. That's end of life. The older monitors are going to need replacing, and there's a fair number of these older monitors installed throughout the world, around 6,600 of them right now. Next slide. Here's what this non-magnetic patient monitor looks like right now. Again, it's completely non-metallic. I know it looks like there's a lot of metal there, but most of that is a special kind of ceramic that you're looking at. It uses proprietary technology on the entire monitor. It's not an inexpensive piece of equipment, but then again, regular standard monitors are not inexpensive either. The current install base of this particular monitor is about 1,600, and they had, until the last 2 months, a direct competitor in a company called In Vivo, and that was a subsidiary of Philips. Philips has announced about 2 months ago, less than 2 months ago, that it was exiting this space. It couldn't compete. And that means that we're looking, at the moment at least, on a very patent-heavy piece of equipment that is very, very desirable for hospitals, and it doesn't appear to have any competition in the market. The big key is portability. It can be taken anywhere, including right up next to the MRI machine itself, if that's where you need to have it. Next slide. These next generation pumps are going to come out in late 2024, early 2025. There'll be a significant opportunity for a large percentage of the present pump needing to be replaced. And there's going to be an increase in the use of these pumps. Right now, the sales on these pumps are increasing at a pretty standard rate, And we're finding that when hospitals discover how well one of them works, they want 2 or 3 or 4 of them to use, even if they only have a single MRI machine in the hospital setting. The next big place where they're going to be moving into a market will be in non-residential hospital settings, in outpatient settings, and there's a large number of those in the United States and worldwide as well. Next slide. Here's their growth. You can read this. They're looking at doubling their revenue from 2022 within the next 3 years. There's going to be a large opportunity in ambulatory imaging centers, that's outpatient, and they've formed partnerships with GE Healthcare, with Canon, and with Siemens. They're moving to next generation infusion pumps, and they have virtually no competition of any kind from any public company. I was not able to parse out any competition from private companies, whether that exists or not. Next slide. This is a small company, and I'm focusing on the last 5 years. We know what happened in 2020, that's the pandemic, but they recovered from the pandemic amazingly quickly. And then we've had good constant sales growth since the lows in 2020 and good constant consistent earnings growth since 2021. This is still an extremely small company. The most recent quarter, you can see 17% sales growth, 24% earnings growth. I'm measuring the growth on the trend lines at about 14% as far as earnings are concerned, and that would give me a 5-year earnings projection of $2.60. You might put that in the back of your head and store that for just a moment. Those projection dots are coming from the Morningstar data that's in your SSG Plus, and I'm using them as kind of guides going forward. There happens to be very little written by the analyst community about this very small company. I've leaned heavily on those dots. I've leaned heavily on manifest investing and in my own experience studying smaller companies. Next slide. I said it was small, and I'm asking you to look at the fundamental data up there at the top of this slide. It was so small that I felt that as a micro company in 2014 through 2018, I could stand to kind of discard what was happening right there. Focusing on the last 5 years, even in the most recent year, they're only selling $66 million of this product. I'm looking at the quarterly data. That's the graph at the bottom. And I'm noticing that my 14% sales estimate going forward and my 14% growth for earnings going forward is a number that has been exceeded for the last maybe 9 or 10 quarters. I've circled the part of the graph where the actual values, the actual quarterly values exceed the earnings call and the sales call that I've made, and that's represented by that solid blue horizontal line. The green horizontal line is directly beneath that because I'm using the same number, and that black horizontal represents the 0 mark. I feel that my numbers are sufficiently conservative enough and that the company is not, I'm not setting a hurdle that is so high that the company cannot at least meet or exceed that forecast number going forward. I'm looking at pre-tax profits headed in the right direction. If you knock out the pandemic year and what was happening then, you'll notice that we have pretty steadily increasing pre-tax profit numbers, return on equity above 20 in the most recent year and at 15 for a 5-year average, even including the pandemic year, and debt to capital at or near zero for every year since I've been taking a look at it. Really, for a small company, exemplary management numbers. Next slide. Here's the data, the actual data. I did cross out the pandemic PEs, which I felt didn't represent anything. And I chose going forward to take the remaining average PE of about 36.7. I've circled it there. And I've decided that's a suitable high PE average going forward. I've kept the altered low average of 24.2 and put that down there in section B. I'm getting a high price of $93, a low price of about $33. I'm getting a buy with a 6-to-1 upside downside ratio. Next slide, Mark. There's the industry study in a thumbnail from Manifest Investing on the extreme left in the upper left corner there. You can see Iradimed at the top of the medical device list and at the top of the whole healthcare industry based on Manifest rank. I think that's how they go onto that list right there. There's my SSG results summary. And the results show that I could stand to get somewhere between maybe 14 and 18% from this very small company. That's certainly acceptable for a great small company. There is an extended value line, folks, but it's data only. There's no analyst estimates of any kind on the value line. And the Morningstar report has a lot of data, but again, there's no analysis available to go with that data. Yahoo Finance does give me a short-term revenue history, a revenue estimate of 10.5. It's a 2-year estimate. They give me a longer-term estimate for, and I have a typo. That should not be revenue, that should be earnings in that second paragraph there. Earnings estimate of 17.5%. Remember, my choice of number was 14%. Manifest uses a 5-year sales estimate of 15%, and they got an earnings number of $3.17. My 14% gave me $2.60. So I think that my SSG numbers are on the conservative side, and surprises, I hope, will come to the upside. At the close of the market on Monday, that's yesterday, the number for par for Iradimed was 20.2%, a quality of 90. I certainly find not a whole lot that I can criticize on this very small company. I will emphasize, however, that the amount of information available is sparse. And if you're going to study this company, you're going to want to do as thorough a search as you possibly can and read every single thing that you can come across before you put your money down with everything else. I'm getting a question, is this a Morningstar stock? Again, there is a Morningstar report, but there's no analytical report in the Morningstar report. There are some numbers there. You'll get a fair value call, for example, and there is an extended value line. That's data only. Occasionally, those data only value lines will give you a 1 or even a 2-year estimate for revenue and for earnings, but this particular value line gives you no estimates of any kind. So there's a real paucity of any kind of data out there. Do your homework. It's a very small company, and that puts it a little bit into the speculative area. This would certainly not qualify as a core holding, at least not at this time.
Very good. Thanks, Ken. All right, Kim wasn't able to join us tonight, so we're going to actually just kind of we'll summarize and then just move on. New management at PayPal. Kim has presented a couple of different times. She wanted to bring your attention to the fact that it was the Value Line 1 stock to buy right now. Pretty good. The Value Line analysts actually walk you through some screening and a discussion of the company, and that's a fairly recent decision that they made. The company continues to appear undervalued by any measure, all the various metrics. And I'm just going to leave us just with a real quick look at this. And I mean, it is a formidable company that has really hit kind of a speed bump. I do find it kind of interesting and questioning, where that number comes from for a future operating margin. It shows up down here. But Kim would like to throw another log on the fire with PayPal. And so with that, Cy, take us home with, it's not an information technology stock, but they probably power information technology companies.
Indirectly, they certainly do. In fact, I can't really tie Excelis into PayPal, but there is a bit of the first 3 sections of the program tonight in Excelis. This is related to the semiconductor industry. It's a semiconductor supplier, which ultimately powers the information technology. So there you go, Mark. And as a supplier to virtually all of the semiconductor manufacturers, both the fab shops, which do other people's designs, as well as the integrated, which do their own. It's a little bit of the Corning glass story that you heard with Gentex. And then it is a small company by Better Investing sales measures that just slipped into the mid-size in 2023, just slipping over that $1 billion in sales. So this kind of wraps up the night so far and certainly indicates why it is such a good stock to consider. Here you can see the history and notice the recent results are quite strong on sales and earnings as well, and reasonably consistent, again, particularly for a cyclical industry like supporting semiconductors. It's somewhat of a growth cyclical, as I think Mark called Gentex. Next slide. Here's where I got it. I was just kind of poking around and thought, let's look at technology, and I looked at the whole sector ranked by quality, and Excelis is the first one that pops up with an excellent quality and a yellow or green return potential. And then I left a few of the ones below as well that you could just kind of get a feel for where technology is. Notice that many of the really high quality, because there's significant chunks that I cut out so that it fit on one page. So you can see that the high quality tech companies by and large are tending toward overvaluation. Taiwan Semi, NVIDIA that you see there at the top. Next slide. Just a quick semiconductor equipment and materials industry study. Again, highest quality with a high par there. So that is ranked by par. Notice it's not the highest quality in the industry, but it's among the highest potential returns, and again, the highest with an excellent quality. Next slide. And then just to check everything, I took roughly 20% par to give me a little bit down, a 90% quality again to capture, and said, let's stick a financial strength of 85, which is just below Excelis's. So essentially look at the whole database, see what's out there, and lo and behold, look at the top potential return and quality and the highest growth. Mark, again, earlier was talking about growth. So here is a chance to improve our PAR as well as tweaking growth, which growth we don't really need, but we certainly need PAR in the portfolio. Next slide. So a little bit about what does Excelis do. I'll just bounce through this pretty quickly, refer you to the website if you want to learn more about the company. A lot of these really high-tech things, I tend to say, don't overthink it. Get an idea for what they're doing and see if they explain it enough that you can generally understand, but you don't need to get in the weeds. They design, manufacture, and service ion implantation equipment for semiconductors. Ion implantation, we'll see in the next slide what it is. The Purion family of products is their main brand, if you will, and they consider that among the most innovative implanters available on the market. And all semiconductor manufacturers use implanters, though different ones use different types, and they sell worldwide, as you can see. Next slide. So what is ion implantation? It's a principal step in the transistor formation cycle. Think back to those TVs Mark talked about. Those were run by transistors and tubes first, and then moved into the transistor age, just like all electronics have. And then, of course, someone developed the way to put transistors on a silicon chip. That's what we call a microchip. So it's a principal step there. And the ion implantation is the etching that sends electric currents on silicon. But also you could see that it can alter the characteristics of silicon for other than electrical, and it's called material modification, and it uses those various liquids, arsenic, boron, phosphorus, being shot onto the laser to implant it. Next slide. Here's starting with the presentation. This just gives you a quick snapshot over the company. It's been around for over 45 years, global leader based in Beverly, Massachusetts, and has employees worldwide. And they serve the $2.7 billion ion implant systems market, which we'll see a little bit about that in subsequent slides. Next slide. Here's just a picture of their headquarters, a new logistics center which powers and drives their U.S. product development and manufacturing. And they also opened a relatively new operation center in South Korea, serving their Asians market. And you see that picture. Next slide. Here is how they have been modeling running the company on a business basis since 2018. And you see the actual figures from 2018 through 2023 as far as revenue and how that has grown, more than doubling in that time. You see the gross margin and how it's increasing, the operating profit and their free cash flow. And then you see that they are aiming toward 1.3 billion over the next, hitting that sales target over the next 2 years. That works out to about 7.5% annually. Next slide. Growth in revenue, but remember that increasing profit margin. Here are the fundamentals that they say will support this growth. Electrification of automotive industry. Chips are everywhere in cars, and they're big into supporting that move. Communications, the 5G, Internet of Things, they're in all sorts of chips there. They've got their fingers in AI. I wish that they had said more about IT and support there, but they certainly indirectly support all of that. Next slide. Here's just a bit that they mention with respect to the automotive industry, and one of the fastest growing areas, the SiC semiconductor, that's silicon carbide, that stands for. And you can just see how those graphs are going up, driven largely by this SiC power in automotive. And TAM, if you're not familiar, that's total addressable market. So that's the market growth, and then they are a major player with over 50%, or I think a little less than 50% of that market. Next slide. Margins, again, improving. We don't need to dwell on it. Just trying to give you the graphics that they are improving their margins as they move into these more advanced, higher current, higher energy producing implanters. Next slide. Here's their business thesis, if you will. Why invest in the company? The implant total addressable market's more than doubled in the last few years, and they expect that to continue. There are some graphs on that third-party analysis in their presentation that you can see how the market is growing. They're the implant leader, I mentioned, in that 50% or higher, and they say that they are the only company with a complete family of implant products in both of those three areas, the high energy, medium energy, and the, shoot, I forgot the third high part, the high energy. If you jump back about 2 slides, Mark, will refresh my memory. Let's go one more maybe. And if not, we'll, all right. One more and then we'll see if that hits it. If not, that's not it. Anyway, there's 2 highs. There's medium energy, high energy. There you go, high current. That was it. High current, high energy, and medium energy. And they are the only company that covers all of that. And then here are my judgments. I decided to choose an 11% growth rate. And the reason I'm hesitating a little bit was I thought I was using these, I lowered that to the 7.5%. I'm wondering, but we'll go with this with the 11% on that. Then you see, this is not, that's what it is. I got my slides confused. This is actually from last month. Click over to the next slide, just see if it's there, but I'm afraid I deleted the wrong slide.
Go with this one.
Oh, yes, that's it. That's a slide that shouldn't be in there. Good. I'm sound lost, but I'm really not as lost as I thought. Here's the history for the company. You see very high quality on the management side, returns on equity, and the pre-tax profit on sales, again, growing margins, reducing the debt. I chose to go with an 8% growth rate, which is right at that 7.5% to 8% they're projecting over the next 2 years. As you'll see in a moment, that's pretty low by some analyst standpoints. And then that gave me a $10.72 EPS, which we can see on the next slide, which I think, there we go. There's the correct preferred procedure. 8% sales growth rate. I'm using the current pre-tax profit margin and the management projected tax rate of 15% to give me the profit margin. Again, notice everybody, management has the margins growing and projects it. Value Line does the same thing, and Manifest does that as well. gives me the $10.72 EPS, and that's to be compared with manifest consensus of 1942 and the BI median for almost 200 studies done on this in the last, 90 days is the heat map. I think the actual sentiment charts go back a little further than that, but that is 1301. So it's certainly conservative. I had a little bit higher figure until I ran, and value line was a bit of an outlier. These numbers track value line a bit. Now I was thinking value line was a bit on the low side till I ran into the company 7.5% figure and said, let's go with that and see what you get. Next slide. And here's what you get. Using a PE high of 27, you get a potential return of 20%, a very healthy potential return. If you use the average PE that I came up with of 20 times earnings, you get a 13%. And notice, compare both of those are actually below the manifest consensus par of 22.8%. And it's largely, again, a much higher growth rate, much higher profit margin. And I'm very comfortable with the conservative company and value line figures. And if we get surprised on the upside with even more growth and more margin expansion, then I will certainly take it, and we can move on up into the 20s, mid 20s or higher on the return. But I suggest that we add, or will add, 1,000 and suggest we shoot for 2,000 in the portfolio.
Way to lobby. Good stuff. All right. One other thing that I wanted to point out is I do think that the analyst consensus has gotten a bit overheated / frothy when it comes to some of these semiconductor and chip companies. Call it the NVIDIA effect. It's created a euphoric confusion. And I think we see some of the air coming out of that balloon now with the current update cycle. So just keep that in mind as you look at any one of these type of companies. And with that, Ken, I think we can go to our poll.
You can change my name, Mark, from Psi risk isn't, or volatility is not risk, to Psi the froth deflator.
Okay.
We'd love to have everybody voting. We have about half of you voting. We're up to 60% voting now. Pick one. Let's put an extra $1,000 in the portfolio for the one that you folks picked. 3/4 voting, 80%. Let's see if we can hit 90%, folks. Okay.
It is Super Tuesday. Vote early, vote often.
Vote early, vote often. Okay. I'm going to count 7 in my head and then shut us down. And we hit 88% as I close the polls. And
Excellent.
Let's share the results. And we're going to add 2 Gentex, although this is really a very evenly split tonight, much more even than it usually is split. So, Mark, should we add $2,000 extra because you and both did Gentex, or 1,000 extra, just for the record?
I was just going to do one more position. Just treat it as one single audience vote.
Okay. So you can all see the results, and I'll cover that up, Mark, so we can go on to the final couple of slides here.
Okay, back at my machine. Just a quick reminder that we do archive all of the roundtables on YouTube under the Manifest Investing channel. And we also put the bull sessions there too. We've had a lot of fun here lately. This is a session that I think people would enjoy greatly. And the groundhog results are there, a couple more over to the right. And yes, that is Mark and Ken in a hot tub on the streets of Detroit. Enough. Why don't you go ahead and tell us where we're going, Ken?
Well, our March roundtable will be on the normal Tuesday, the last Tuesday of March, the 26th. We will be running a successful investing conference. It's another iteration of our better investing. And we're talking to novice investors again. We're going to be taking the next steps from when we were with them this fall. Those classes will be on the 10th and 11th of April. We'll be visiting the Southeastern Michigan chapter on the 20th, and our April roundtable will be in cahoots, conjoined. We're going to be holding hands with the St. Louis chapter, and the St. Louis chapter and the Mid-Michigan chapter together will be putting on the April roundtable. And then, of course, Mark and I and Cy and Kim, and I don't want to promise anybody else being there that I don't know about, but at least those four names I know will be at the National Convention in Chicago on May 16th and on May 19th. So lots of stuff going on in the next 3 or 4 months, and we hope to see you all. The first 4 things on the list are absolutely free, and if you need information on how to register for any of them, drop me a line, drop Mark a line, and we'll be sure to help you out. With that, Mark, I want to say thank you, to all the damsels, to all the knights that have helped out this last year and in the 14 years we've been doing this. And let's start a fresh roll call here on the 15th year in the next roundtable, and see if you and I can, well, you got a lot of awards tonight. See if I can maybe get 2 of them for next year. Okay, here we go.
Well, at least Kim didn't take them all away this year, or you.
Well, you're right. Okay, thank you again,
Well,
everybody.
everybody.
Audience, thanks for coming, and we certainly appreciate you being here. And I'm going to wish you all a good night and close the meeting down. Good night, everybody.
All right, thanks everybody.
Night.
Good night.
Okay.
Good night.
Congratulations, Mark.